Energy risks may be easing, AI capital spending is exploding, and equities are still pressing record highs even as inflation refuses to fade. You are watching vTalkInsight Equity Pulse Daily, and today is May 8, 2026. We will unpack how this clash between growth, inflation, geopolitics, and technology is shaping equity risk and opportunity right now. Equities are hovering near record highs while the macro data point to a classic late-cycle mix of firm growth and sticky inflation. Nominal GDP is projected around 6% this year, supporting solid revenue growth and pricing power for many S and P 500 companies. On the other side, core PC inflation has been running near 4.4% annualized over the last 3 months, and market inflation expectations have pushed above 2.5%. That combination is testing the Federal Reserve's easing bias. The Fed remains on hold, but several other central banks, including in Norway and Australia, have resumed tightening, and the debate is shifting toward policy staying higher for longer rather than turning easier. Labor data are mixed. Initial jobless claims are still very low by historical standards, yet unit labor cost growth has roughly halved, pointing to some moderation in wage pressure. For now, the rates market assumes 10-year Treasury yields will oscillate in a mid-4% range, limiting fears of an immediate shock to equity valuations. The equity side looks more finely balanced. Forward price-to-earnings multiples on the S&P 500 are in the mid-20s, and the earnings yield has converged toward 2-year Treasury yields around 4%, leaving little valuation cushion if growth or policy disappoint. Stable earnings compounders such as Walmart and Costco still trade on rich premiums even though their growth has not accelerated materially. Leadership is also narrow, with a handful of large technology and communications names accounting for most of the recent earnings upgrades, while the equal weight index lags. Yet flows remain decisively risk-on. Retail technology buying is at a 1-year high. Hedge funds focused on tech just posted their strongest month since 2020, and there is still meaningful institutional cash on the sidelines. Volatility indices, sitting in the high teens, capture that tension between stretched valuations and powerful liquidity support. Energy and geopolitics remain the key swing factors around this otherwise supportive backdrop. Hopes for a deal between the United States and Iran to end the conflict and gradually reopen the Strait of Hormuz have underpinned the recent risk rally and driven Brent lower for several sessions in a row. Oil has dropped back from the $107 to $108 area toward the high 90s, easing immediate pressure on fuel-sensitive sectors. But the process is fragile. The current proposal points to a phased reopening of Persian Gulf shipping lanes over roughly a month, while difficult issues around Iran's nuclear program and frozen assets remain unresolved. Estimates suggest that hundreds of millions of barrels of crude could stay effectively stranded during this period, and Iran's newly announced Persian Gulf Strait Authority has yet to restore normal traffic, with many vessels still avoiding the region. Those bottlenecks are keeping global freight routes distorted and support elevated shipping rates. Maersk, for example, beat first-quarter expectations, but is guiding to about $1.5 billion of extra costs next quarter due to rerouting, and plans to push those through to customers. If end demand eventually resists these price increases, the risk is a stagflationary mix of higher headline inflation and softer volumes. In the near term, integrated energy companies are clear beneficiaries. Shell has just delivered adjusted profit close to $6.9 billion, ahead of forecasts, and launched a $3 billion buyback, citing higher oil and gas prices and strong trading income from volatility. That illustrates how earnings can stay robust for producers even as consumers and transport operators face rising costs. Regionally, Europe looks most vulnerable to another energy shock layered onto already tight monetary policy, and many expect European equities to lag if oil or freight spike again. By contrast, Japanese markets have reopened from the Golden Week holiday with strong gains, helped by global strength in chips and enthusiasm around AI, with names such as SoftBank participating. The coming Trump summit and ongoing diplomacy by U.S. and European officials are therefore important catalysts for whether the current peace premium in risk assets persists or quickly unwinds. Under the surface, the dominant equity narrative remains the AI and data center investment cycle. Major cloud platforms are committing very large, multi-year capital budgets to AI infrastructure, with some estimates putting annual spend near 1% of global GDP. That is flowing straight into semiconductors, power, networking, and specialist real estate. Anthropic offers a clear snapshot of the demand side. Management reports revenue running roughly 80 times higher than a year ago and has secured huge compute deals with Amazon, Google, and SpaceX. Its latest agreement with SpaceX's NVIDIA-powered Memphis data center will add substantial capacity, allowing the firm to lift rate limits and keep pace with rapid user growth. On the infrastructure side, HUD 8 has lined up almost $17 billion of AI-focused data center leases in the southern United States and financed them with bonds backed by long-term, investment-grade tenants. Institutional ownership has surged as investors buy into that recurring revenue model, highlighting how equity and credit markets are financing the same AI build-out. Chipmakers remain central to this story. AMD's share price jumped about 18% after AI-driven earnings, while ARM Holdings expects data center demand to more than offset smartphone weakness, with its new processors potentially adding around $2 billion of revenue over the next few years. AI-linked orders are also lifting suppliers in optical and telecom infrastructure and industrial names such as Legrand, which just beat earnings on stronger demand tied to both AI and the energy transition. At the same time, markets are becoming more selective. AI capital expenditure is clearly denting free cash flow at some large technology firms, and the focus has shifted from grand capability claims to tangible revenue, margins, and enterprise adoption. The expected wave of AI-related investment-grade bond issuance over coming years underlines both the depth of this capital cycle and the potential credit risk if cash flows do not materialize as hoped. Outside technology, the micro data reveal a more uneven backdrop. Real consumer spending growth in the United States has slowed from roughly 2.5 to 3.5% to near 1.5 to 2%, with further deceleration expected as real wage and salary income softens. Real incomes have been negative in 4 of the last 6 months, and wage growth for high-income households, around 6%, is far outpacing the roughly 1.5% seen by lower earners. Company results reflect that split. Whirlpool has cut revenue and profit guidance, suspended its dividend, and warned that its industry is experiencing conditions similar to a recession, linking the weakness to poor sentiment since February and to the impact of the Iran war on costs. Campari and Pandora both highlight softer demand from middle and lower-income U.S. consumers, even as Pandora continues to grow strongly in less penetrated regions such as Asia and Latin America. Advertising-sensitive names are also feeling geopolitical strain. Snap reports a severe hit to its advertising business from the Middle East conflict and has ended a key AI partnership, with the stock down more than 10% pre-market. That stands in contrast to the stronger AI monetization seen at larger platforms and underscores widening dispersion within the tech complex. In contrast, the upper-income and digital consumer remains resilient. DoorDash shares jumped over 10% on an upbeat order outlook. McDonald's has beaten earnings expectations with larger, higher-priced orders, and Match Group's Hinge brand is delivering about 28% revenue growth through international expansion. Travel and luxury spending remain firm in many reports, reinforcing the idea of a bifurcated consumer rather than a broad-based collapse. Layered onto that is a credit picture that looks calm on the surface, but more stressed underneath. Public credit spreads are tight and yields still seen as attractive, yet private credit funds are reporting real defaults, valuation markdowns, and rising redemption intentions. Many portfolios are heavily exposed to low-rated borrowers and to sectors such as commercial real estate that face a looming refinancing wall at today's higher rates, leaving equities supported by strong balance sheets and high-income demand, but more vulnerable where business models depend on stressed consumers or cheap leverage. As we wrap up, equities are still powered by strong nominal growth, an intense AI infrastructure cycle, and ample liquidity, but valuations are rich and leadership remains narrow. Energy and geopolitics are the main swing factors, with any setback in U.S.-Iran talks or around the upcoming Trump summit capable of reversing the recent peace premium in oil and freight. At the same time, stress is building beneath the surface in lower income consumption and in private credit, even as high-income demand, solid corporate balance sheets, and tight public credit spreads keep overall risk appetite intact. From here, the key signals to watch are inflation trends, real wage growth, the pace of AI capital expenditure, and any shift in central bank rhetoric. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.